Now, going to the next presentation, I'm going to spend another 15 to 20 minutes briefly describing the ESG framework that has been developed in the European Union lately, with all these regulations that Vasiliki Lazarakou, the chair of the Hellenic Capital Market Commission, briefly talked about. So to see the real value and significance of ESG risks in sustainable finance. So this is the universe of sustainable finance market participants that we have in the market so far. We've talked about corporate listed firms from the chair of the Hellenic Capital Market Commission, but also SMEs, like the chair of the Hellenic Development Bank was talking about. And the other side, there are the investors. And here we're talking about asset managers and asset owners that actually give the mandates out for the effective management of the funds. On the other side, we have the financial intermediaries, which are banks and private equity funds that actually leverage the money for the investments. And on the other hand, we also have multilateral development banks. We've heard a national development bank, but we have the chance later on today to listen to Multilateral Development Bank. And we also have some service providers. Could be rating agencies. Vasiliki briefly talked about this. Data banks, the need to get credible data. Consultants, and we also need to have assurance providers and media. And last but not least, we have the regulators, as we had this morning, and even public asset development funds that are structuring ESG rating models in order to be in a better position to assess the ESG risks of their portfolio and their assets. So all these market participants are actually somehow engaged into what we call sustainable finance and the assessment of ESG risks. Going forward, we have developed as Global Sustain as well several sustainable finance services in order to meet all this coming demand. And this is actually what you can pretty much get out in the market in terms of non-financial reporting. We heard from the chair that it's mandatory for some size companies, and there's also frameworks out there in the market that you can do this sustainability and non-financial reporting. There's also environmental and social risk management, and this is done mainly through the financial intermediaries like banks and private equity funds, but also the ENS risk management should be for every corporate of at least at some size. In terms of regulatory compliance, there is the framework that I'm going to present briefly. It's called the Taxonomy, and we also are going to see some reporting guides already issued also by the stock exchange here in Greece and other capital market participants. There's also work going on in policy and dialogue. Regulators talk to each other, they convene in groups, and they drive policies. We talked about the European Securities Market Association, for example, and there is a lot of research in the field. Academic institutions produce a lot of evidence and research that actually correlates the positive financial performance with ESG performance. Global Sustain has been well positioned in this market, and we've already have some very important clients and partners that we work with, and are also enjoying not only services but also a framework for a collaborative framework under Global Sustain. There's all sorts of financial market participants like banks, asset management companies, private equity funds, data providers, regulators, and of course we have initiatives such as the Global Compact, TCFD, and so on and so forth. In order to be able to deliver such services, there's a big initiative by the United Nations Principles for Responsible Investment that Global Sustain has been a signatory since 2014. So we actually have this capacity and knowledge to provide such services for the market through our companies in London, in Berlin, in Athens, and associations in other countries. We also produce a report on that on an annual basis, which you can click on this slide and be able for our not only clients but also stakeholders to see what we've been doing all year around. Just to verify the previous speaker's words, we can see at this slide the advancement of ESG funds that subscribe to the principles for responsible investment. The PRI has now more than 3,000 signatories. Signatories come from all over the world, including Greece. And the assets, the total amount of assets that have subscribed is more than $100 trillion US dollars now as we speak. And you can see at this slide how the market has grown, especially during the last years. Also to give some local flavor, there are 8 signatories now to the Principles for Responsible Investing. That have actually signed up the last 1.5 to 2 years, all with the support of Global Sustain, and we're very proud and happy to drive this market in Greece. It's Eurobank Asset Management, it's Alpha Asset Management, Piraeus Asset Management, NBG Asset Management, so all the systemic banks' investment arms, plus the independent, and that's what makes us extremely happy, asset managements like the Iolkos investments, the Hellenic Asset Management, Triton Asset Management, and Alpha Trust. And as I said before, these 8 companies join a family of more than 3,300 asset owners. Going now to some data and market statistics, I would like to share with you how the ESG performance is correlated with this market performance. And at this slide, where we see the ESG returns as measured by MSCI, we can see that over the last 5 years, compared to S&P 500, the benchmark, all major ESG indexes like Sustainalytics, Refinitiv, MSCI have outperformed the benchmark of S&P 500. And if we take this to a smaller time period, especially during the COVID-19 pandemic, we can see that the funds coming to ESG and the returns of ESG allocated funds has increased. So at the next slide, which is provided by Bloomberg Green, we can see that the green energy stocks from March till later this year have actually outperformed the benchmark indexes of S&P. So this is like a proof that ESG funds actually outperform the market and in a very significant stage. And this is also approved by another graph we get from MSCI, where they compare all their mainstream stock market indices with their ESG focus indices. And we can see here, especially that during the COVID-19 pandemic, since the beginning of the year, the spreads are widening between ESG returns and mainstream returns. To make my case more clear, I would like to also give you a figure by Morningstar that they actually measure the sustainable funds that come into ESG management, and 2019 has been a record year. And just yesterday also, Bloomberg has announced that we've reached a very significant point of more than $1 trillion US dollars in sustainable finance just yesterday. Figures also mentioned by people that spoke before me. I would also like to show you a very distinct graph, especially that's for the last period when the inflows of capital into ESG funds continues growing, while the inflows to ESG funds, non-ESG funds, is decreasing. And you can see here the circle in the graph. At this point, it's the month just before the lockdowns in Europe and elsewhere in the world. That's money going to ETFs in 2020. The most important things is to understand what is the meaning of ESG. And for several people, this can mean different things. And I would like to comment on a very interesting report by MSCI, which has which attributing several significance to E scores, S scores, and G scores. And if we would select one of these three pillars, it says that the most significant will be governance. And indeed, everything starts from the governance. This has been also verified by an independent research we did as Global Sustain together with the Financial Engineering Laboratory of the Technical University of Crete. And we researched more than 20 now rating agencies, development banks, and other financial institutions, how they measure ESG risks. And over the next 3 slides, without going into much details, I'm going to give you the most important factors of E, S, and G. And you can take this presentation along with all other presentations after the forum. It's going to be delivered to your electronic bank by the live on platform. And you can see all this data that I'm talking about. So at this slide, you see the 20 most important environmental issues. We together with the university, we evaluated the significance, the materiality of ESG factors. Here are the environmental issues like greenhouse gas, climate, packaging, product safety, supply chain issues, air quality, waste, the usual ones. In social issues, we have issues like local communities, human rights, employment, diversity, responsible pricing, labor practices, etc. Another set of measures is about governance, and here you can talk about board, cybersecurity, data. You can talk about shareholder engagement. You can talk about if companies have sustainability strategy, like we heard before, codes of conduct and policies, and other corruption and bribery. It's a very important also issue. Now, going forward, I would like to give you these regulations that Vasiliki from the Capital Market Committee was talking about. And here are at this slide the 3 regulations that started since 2018, when we have first had the Sustainable Finance Disclosure Regulation for investors. Then also in November, we had the regulation for the benchmarks. It's the second one on this slide. And on the just 3 months ago, in June, we had the taxonomy regulation, which is something that I would like to talk briefly about, because all regulations are in place with different dates of application. And I would like to talk briefly about the last one, because for the first time, we have a definition for ESG. And it's called, what is a sustainable investment? So this is what the framework is doing, right? They provide a dictionary of what is green, what is sustainable. Sustainable investments have the E pillar, so the taxonomy is only about the environmental issues. We're very much looking forward to an S taxonomy on what is social. And of course, governance practices refer to management structures, employee relations, remuneration of staff, and tax compliance. So the taxonomy is actually a dictionary of how activities, economic activities, can contribute to 6 major objectives. And these objectives have to do, as you can imagine, with climate change mitigation. They have to do with adaptation, circular economy, prevention and control of pollution, sustainable protection of natural resources and water, and of course, biodiversity and ecosystems. At this slide, you can see these 6 objectives. But these 6 objectives are not enough for someone to be called green, right? They also need to make sure that they apply do no significant harm standards. For example, they may do good to one of these objectives, they should not harm the others. And on the other hand, they should also have some minimum standards like universal declarations of human rights or the International Labour Organization principles, etc. As I said before, the taxonomy is a very useful transition tool. It's a dictionary for every technical criteria for these activities that have already been recognized. You measure, so everything is comparable. It's a dynamic tool. As the chair of the Hellenic Capital Market Commission said, this is going to give us tool for ESG labels in the future. But it's also an engagement tool. It's an alive document that's continuously been updated from the regulators. So everyone needs to do some sort of reporting in order to claim that they are green or sustainable. And they need to disclose that in their annual reports. So it will be included in the typical financial statements of the organizations. And this is actually going to help a lot the debt and lending related products, because companies that are not, let's say, so much green, they will need to make use of this regulation and see how they can adapt to the new transition economy and low carbon economy. And here's an example of an aluminum company that wants to take a debt product for a green loan or a bond or a carbon bond, because they want to minimize the CO2 emissions in their factories. So they go to the bank requests the data, then the bank makes sure that the taxonomy is in place and aligned all these expenditures, and then they put the project in place, the CO2 emissions reduced, then we have revenues coming out from this. And this is going to a securitized program, as the Hellenic Development Bank briefly mentioned before. And then the bank sells this to the investors. The investors buy this product and they claim that they are green. So here, at this simple graph, everyone is adopting the sustainable finance regulation for their own purpose and interest. And at some point, the investors will come and claim, based on the revenue that these companies disclosed, how much they are aligned to this taxonomy. So here is an example on this slide about a fund that is actually applying, has 3 companies in its portfolio, and they have allocated their weights on the portfolio, also the weights on the taxonomy, how much green they are, the individual company A, B, and C, right? 12%, 8%, and 15%. And then they have, doing the math, they have declared that their equity fund, it's 10% taxonomy compliant. So it's really hard to see, and as we're doing some tests, that many portfolios are very green, even though now everyone claims that they're green. So it's going to be an interesting market. It's been developed, how really the taxonomies follow the technical criteria of this taxonomy. And let me give you an example here, just to make it a little more practical, about a case study of a utility company. Let's say that this company has a total turnover that comes from 3 different revenue lines. The first one, it's coal-powered energy revenue, or at step 1, as you can see on your screen on the left side. Then we also have revenues coming from a hydro-powered energy, and the third one from a wind-powered energy generator. So this actually company has declared in its financial statements that the revenues come from these sources. As you know, coal is excluded, is already in the exclusion list of major investors around the world. as it's also in the taxonomy. So this 25% revenue coming from this stream cannot be taken into consideration. Now, at the second one, which is a hydropowered energy, we see that the company does not get the threshold, the technical criteria of the taxonomy. So in other words, it's not used to align this with the taxonomy. So we take only the wind park with the wind farm or whatever energy generator from wind is that it's 50% alignment. There is no threshold for that. So only the 50% of the revenue is going for alignment with the taxonomy. And then after we investigate if the company is not doing harm to other objectives and if they pass the minimum safeguards with International Labour Organization, OECD, and all that stuff. So at the end of the day, this company is 50% aligned with the taxonomy. I'm going to leave you with the last slide for this presentation, which is how much is this market. As we've said, the European Commission has made three big pledges, right? Three big promises. First of all, that they're going to contribute, and they adopted the Paris Agreement, which means lower than 1.5%. Celsius degrees increase in the climate. And then we have the Sustainable Development Goals of the UN and the Green Deal. The Green Deal is the commitment of EU to become a carbon neutral continent by 2050. This means 1 trillion of sustainable investments over the next decade. And that was announced by the Commission earlier this year. And this is actually what's going to drive this market. So it's going to be a very interesting time period ahead, how banks, regulators, companies are going to challenge themselves in order to build internal capacity, knowledge, tools, methodologies, and of course products to serve this market. So thank you very much for listening to this presentation.